Hello, I'm Yiorgos Allayannis. I'm on the faculty here at the Darden School, and as part of the University of Virginia Investing Conference, I'm delighted to have with us Ms. Sheila Bair, and I look forward to ask you a couple of questions.
Okay.
Sheila, 5 years from the onset of the financial crisis, is our financial system safer?
Well, it's more stable. We have more capital in banks. There's less leverage in the financial system. That was a big problem during the crisis. The funding, the sources of funding that banks use to support their operations is more stable now. There's still some problems, but less reliance on very volatile short-term funding. So that's a positive thing. I think the longer term, though, just looking at future risk, I think the next potential crisis to hit will stem from sovereign debt problems here in the U.S. if we don't get our fiscal house in order, as well as potential interest rate volatility, either stemming from investors losing confidence in the financial integrity of our government, or inflation starting to get out of control, and the Fed having to step in with higher interest rates. So it's these are very uncertain times, and this very protracted period of near zero interest rates, I think, has really created the mother of all bubbles. And what happens with that, how we get out, how we make sure that's a gradual exit as opposed to a sudden shock, I think is a real problem.
So it looks like you're still concerned.
I'm very concerned, and I'm also concerned, and I'll be talking about this a bit at the conference today, is that regulators are still struggling. As you say, 5 years after things really started to implode, we're still struggling with these reforms, and we're still debating in Washington whether bank capital should be raised or whether we should have better regulation of money market funds. So we're still looking in the rearview mirror, trying to fix things that we know were broken during the crisis, and there are pretty obvious ways to fix them. We're still fighting those past battles instead of looking forward. And trying to make sure we have a stable system that can be in a better position to withstand future financial shocks.
And in your view, is there one thing that if we did, we will all be better off?
Well, I think in terms of bank regulation, constraining leverage, we've made some progress there, but the rules have not been changed yet. The rules still allow a lot of leverage. And even with the stress testing process, which has gotten more capital into banks, they still have a ways to go. The nice thing about bank capital is that it's very difficult for regulators to anticipate what the new product innovation or other, risk area that's going to blow up in some banks' face. It's just very difficult to know that. But if you make sure everybody's got a nice fat cushion of capital, there's loss absorption capacity there, which we didn't have going into 2008 because of all the excessive leverage that so many financial institutions had taken on. So if I had to pick one, there are a lot of things that need to be done. If I had to pick one, it would be really get those capital levels up.
And Basel III doesn't quite
get
us there?
Basel III is, no, it's huge progress. It's huge progress. Prior to the crisis, regulators let a lot of things count as capital that were really debt, like TRUPS, trust preferred securities. So Dodd-Frank gets rid of that. Basel III gets rid of that. Basel III also creates some much stronger definitions of what we can count as capital. So it's really just tangible common equity, which is what the market looks to. So that's huge. And getting those rules in place on the quality of capital is very important. Basel III has an international leverage ratio, and we fought very hard for that. So bank capital requirements, international bank capital requirements have, before Basel III, just relied on what a bank said the riskiness of its assets were, and there's a lot of subjectivity built into how banks could judge the riskiness of their assets. So there are very problems with these risk-based capital standards. But having a leverage ratio, you don't risk weight the assets. It's just whatever your assets are, you've got a 3%, it's actually 5% here. And so that was, getting an international agreement was huge. The 3% needs to be higher. But the 3% does also, for the first time, start counting off-balance sheet exposures, which our leverage ratio here in the U.S. does not. So those are very important things. I'd like to see the 3% become 8%. I'd be good with that. And I think you could go even higher for the very largest financial institutions. But just with those two changes, improving the definition of capital and having an 8% leverage ratio would be huge.
That's great. Yeah. Do you, the capital improvement notwithstanding, do you think we still have a too big to fail problem?
Well, we do. There's been progress in getting rid of it. Dodd-Frank, we fought very hard and had to fight some of our regulatory colleagues, frankly, on this, but we fought very hard to get a ban on one-off bailouts. So you just can't do it anymore. You could do it prior to the crisis, and we resisted those measures as well, but there were insufficient tools prior to Dodd-Frank to deal with any large financial institution outside of an insured depository. So the FDIC had a very good established bankruptcy-like process for insured banks. But with these AIG, Lehman Brothers, those were not banks. You know, they weren't insured banks. Mm-hmm. And even with Citigroup, and then B of A with this Merrill Lynch acquisition, there was most of, not all, but a lot of the high-risk activity was outside of the insured bank and the holding company, where again the FDIC couldn't use its resolution process. We got that fixed in Dodd-Frank. You can now resolve the entire financial institution, and with those new authorities, we have a ban on one-off bailouts. You can still, if you have a system-wide crisis that is impacting, dealing with factors beyond the control of bank management, then there is the ability to step in, provide system-wide support to solvent institutions. But the kind of one-off bailouts that we saw during the crisis are a thing of the past. And because of that, and there's very explicit language on that in Dodd-Frank, the rating agencies have started to downgrade some of the larger financial institutions. They used to get a bump up for their implied government support. We haven't got rid of all that, but it is being reduced.
Interesting. So where do you come out on this in terms of the future of financial?
So I can tell you what I hope. what I hope the future financial services is.
I do teach financial institutions,
yes,
so I'm very interested.
I think getting back to basics, getting back to taking deposits and making loans for banks that are in the safety net with deposit insurance. I think getting rid of a lot of the speculative activity, especially in the derivatives market, moving the vast bulk of derivatives trading, which is now off exchange, onto regulated exchanges and centralized, well-regulated, centralized clearing mechanisms. That's the future of finance that I would like to see. I think investors need to recognize that the financial sector is probably going to be getting smaller. It was too big prior to the crisis. It had become bloated. One of the negative outcomes of the bailouts is we didn't really fundamentally restructure then when we had a chance. So we propped up all the big ones, and so they're all kind of out there now. And the ones with a lot of legacy assets are struggling more than the ones that were healthy during the crisis. And that's creating competitive disparities, actually, because the better managed banks are picking up a lot of market share to the detriment of the other weaker ones that needed the bailouts. So I think the reality is these institutions are going to get smaller. Hopefully they'll get more efficient. I hope they'll also be more transparent to investors, that investors will understand their money's at risk. If they invest in a large bank, they will be subject to loss if that bank fails, and that will provide more market discipline. And I think actually that will be a pressure on individual institutions to downsize as well, because right now these very large multi-trillion-dollar institutions with their huge trading books and derivatives operations and commercial banking and payment processing and all the things that they have, they're very difficult for investors to understand. They can get away with that if investors think they're guaranteed by the government. They can't get away with that if the investors understand government's out now, no more bailouts.
Well, Ms. Bair, thank you so much.
Sure.
It's been a pleasure.
Yep, my pleasure. Good questions. Thanks.